Equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that covers our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Earlier this week, we had a crack at talking about the world's energy transition, but I'm glad today we've got an expert joining us to, I guess, correct our misunderstandings, go deeper on the topic and really understand the investing opportunity that's here.
Absolutely. And not just any expert, but an Equity Mate's favourite expert. We've had a lot of demand for this expert to come back on the show. So it is with great excitement and our absolute pleasure to welcome back Mary Manning to the show. Mary, welcome.
Hi, guys. Thank you so much for having me back. It's always a pleasure to speak with you.
And I do not lie, it's in the last couple of weeks, we've had a lot of the community reach out being like, when's Mary back? So,
oh, great. That's very nice to hear.
So we're excited for this one. If you haven't come across Mary before, firstly, go back and listen to our first episode where we spoke about the Asia opportunity, which was a fantastic episode. But Mary is a portfolio manager at Alphinity Investment Management. She manages the Alphinity Global Fund and Global Sustainable Fund. Has plenty of experience having worked at Oaktree Capital and Soros Funds Management in New York as well. But please do go and listen to our previous episode. It was an absolute pleasure. We certainly got a lot out of it. Today, we are going to be discussing the energy transition and the investment opportunity of decarbonisation. And this episode is proudly sponsored by InStyle Solar, who are one of the largest companies in Australia, solar companies in Australia, and a Clean Energy Council approved retailer. Not only is solar a clean energy solution, but there are plenty of financial benefits as well, some of which we'll touch on later in the episode. So if you would like to get a solar system for yourself, InStyle Solar are offering Equity Mates community 10% off a new solar system. You can book a personalized consultation at instylesolar.com/mates. But enough of that. Let's get on to the show.
Let's do it. So, Mary, after that long run up from Bryce there, I think we'd love to start by taking a step back and framing the conversation in what's happened over the past few decades, because there's been a lot of change and there's been a lot of headlines around, obviously climate change, but also the need to decarbonize the electricity grid. If you can take us back, maybe let's go a couple of decades. Where were we and where are we today?
All right, that is a fantastic place to start. So about 20 years ago, the energy mix was still almost exclusively in fossil fuels, so in oil, gas, and coal. And if you look at any of the charts that are out there that look at the energy mix before that, even for hundreds of years, it was all predominantly fossil fuel based. And then probably a decade or two ago, that started to change for a number of reasons, but obviously the push towards decarbonization was one of those. And so you started to see the rise of different renewables. So in renewables, obviously there's solar, wind, hydro. Increasingly, there's different kinds of renewables like biofuel or other sorts of renewables. And right now, the mix is still about 80-20 in terms of 80 at fossil fuels and 20 in renewables. But as you guys know from your previous podcast, to make some of the Paris Agreement targets, or even to make targets that are even close to that energy mix has to continue to change over time so that renewables take a much, much bigger slice of the pie and fossil fuels take an increasingly smaller slice of the pie.
So you did mention there are a number of reasons for this change, but let's start with the cost side of things. How does the cost of renewable generation compare with fossil fuels, and how has this changed over the past decade?
So this is one of the main things that has driven the rise of renewables. And it's important to point out that this is relative, right? It's not just the absolute cost of renewables, it's the cost of renewables relative to what's going on in fossil fuels. So solar would probably be one that I would call out as the renewable that has the most reduction in cost over the last few years. So say from 2009 to the beginning of 2020, the cost of solar is down about 89-90%. So that is absolutely massive. When we get to the investment part, we can talk about why that is and what that means for companies, because that's great if you don't want to use solar energy, but if you're a company and your ASP is going down by that much, that can actually throw up problems from an investment perspective. So solar has gone down a lot, and then wind. Onshore wind has been historically where where a lot of the wind power has come from, that cost has gone down. And now you're seeing a larger push into offshore wind, and those costs are expected to come down over time. So wind and solar are the two where I would call out the significant decrease in cost. On the other side of the relative trade, you need to look at what's going on with fossil fuels. And this is why I think doing this episode at this time is absolutely fascinating, because you have an energy crisis almost in Europe and a lot of the Northern Hemisphere. So, I mean, if you think back to COVID, remember oil was around 20, and there was that one day when oil futures actually went negative. And everyone was thinking, well, what is that? What does that even mean? And so if someone had told you, fast forward a year, 18 months, and oil's going to be at 80, I don't think anyone would have anticipated that. And natural gas prices have also had a huge leap higher. And so when you look at that relative trade, that, renewables costs are still going down, and that you've seen this sort of resurgence for a number of reasons, both on the demand and supply side, the relative attractiveness of renewables is quite strong right now. The other thing that I will highlight is that there's no OPEC in renewables. So on the oil side, since many, many decades, you've had a big international body where there's lots of participants, and they have mechanisms to sort of control the oil price. And there's no analogy or similarity in terms of renewables. So that also has a big impact sort of on the relative pricing of renewables versus fossil fuels.
Solar generators don't get any ideas. We don't need a renewable OPEC.
Yes, exactly. That wasn't a suggestion. That was just a comment.
So on the point of it's all about relative cost, the cost of putting on like a megawatt of solar or wind compared to putting on a megawatt of coal or gas, is one now absolutely cheaper than the other, or is it, still dependent on where it is and how they're building it and stuff like that?
No, so absolutely cheaper. The interesting thing that you brought up coal is that the cost of coal has been relatively stable through all this. That's one, it's not in the oil and gas bucket, and it's not in the renewables bucket. So it's been relatively stable. So if you look at a chart of the pricing, like solar and wind have gone down and coal has gone flat, and the other ones are sort of up and down with the trend generally down. So yeah, in terms of adding additional capacity, actually another thing that I should add is that we're talking about global here, and within different countries, there can be a huge differential between the cost of different renewables and of fossil fuels. So one of the reasons that there is this crisis in Europe right now is because you had very little wind in the North Sea during the summertime, and you had a drought in large parts of Europe. So hydro literally dried up, and wind wasn't producing as much into the grid as it had historically. And then natural gas, which is by some seen as a sort of transition fuel, there were issues with the natural gas supply coming out of Russia. So all of a sudden you have and nuclear is very, very hotly debated in Europe about whether it's renewable and whether it's good and whether it's bad and a lot of things. So you had sort of that perfect storm that resulted in a very specific issue in Europe, and you're not seeing that in other parts of the world. You are seeing that a little bit in China. It's just something we can talk about later. China obviously has a 2060 net zero commitment, and to get there, they have to work backwards and have very specific interim targets. And right now you're seeing a sort of power crisis in China also, because even those very near-term targets, companies just can't make them. So they're trying to make the targets by shutting down, which is obviously not good for the overall economy. So in general, renewables cost is going down and is getting cheaper than a lot of the traditional fossil fuels, but it does differ around the world depending on what country you're talking about.
A second driver for this transition that we're seeing is obviously the commitments from a lot of governments from around the world. Biden's come out to say 100% carbon-free generation by 2035. I guess the question is, how are these commitments actually translating into policy or action? And are they?
Yeah, so, well, that is also a good question. I think it's important to highlight that there's, again, a very wide range around the world. And we sort of divide it up into there's net zero in law, there's net zero in policy, there's net zero that are like under construction, and then there's countries that are like, we don't care, we're not saying anything about this at all. And so, the interesting thing is if you look at like countries like France, so they have a net zero 2050 target, and that's actually in law. And then you have a lot of other European countries or, Canada, Japan that have net zero 2050 targets that are in policy. And then you have big countries like Russia and India, who are massive economies with massive populations and are very fast growing, and they have no net zero target at all. So there's a very wide range out there. I think you started the question by talking about Biden. As you would know, the original initial Paris agreements were signed in 2015, and then Trump came in and pulled America out, and that sort of lost a lot of momentum. So any country that wasn't committed, that Trump kind of gave them an excuse to not get committed. And then near the end of Trump administration in 2020, China actually came out with the 2060 net zero, and that is an absolutely huge thing. You know, we've talked about China extensively before in another context, but to have China is by far the biggest emitter globally, so to have them on board is a very strong signal. And China is also a developing country, and so a lot of the commentary around just transition and can you have developed countries and developing countries having to have net zero targets at the same time, China really dealt with a lot of that all at once. So then, obviously, Biden became president, and he re-ratified or rejoined the Paris agreements, and then you've seen a lot of more policies coming from there. Europe, as you know, is far ahead, way far ahead. So, you know, if you have the European Green Deal and you have that translating into Fit for 55 sort of policy, it's not legislation yet, but like policy initiatives, there's a lot going on in Europe, and I think that Europe will continue to be a global leader. The thing is, like I mentioned before, is what happens to the laggards, Russia, India, and will China be able to make that 2060 target? These are very long-term things, and I don't think there's certainly a commitment there. But I spend a lot of time looking at the near-term targets, so the interim targets for 2030. This goes for both governments and for corporates, because 2030 is not that far away. No. And you know, when people first started talking about it, it was long away. But now, like if you're a CEO, you could still be the CEO in 2030. So you better be really careful about what you're saying about your company's net zero targets, because you may still be around when you have to deliver on those. And the same for governments. If you're a president or a prime minister and you commit your country to something in 2030, that could be an election issue for you if you don't deliver. Yeah, I guess to sum up, there's a wide range of what's going on in terms of policy. I think it's important to focus on both the interim targets and then the longer term goal for 2050.
Mm-hmm. So we've mentioned cost and we've mentioned government policy. Are there any other key drivers that we should be aware of when we're thinking about this transition?
Yes, I think that the collaboration between governments and corporates is absolutely amazing. It is a rare example. COVID is maybe another example of where, you know, a lot of the world is pulling together and different stakeholders are pulling together, all working towards one goal. So I'll give you some examples from our portfolio at Alphinity. And just to be clear, I'm one of a number of portfolio managers that manage the fund. So it's not just me, but we do have the Global Fund and we have the Global Sustainable Fund. In the Global Sustainable Fund, we have 8 of the top 10 positions have a carbon target. 3 of them are already carbon neutral. And if you are in a meeting with investor relations or with management, it's rare for a lot of these big global companies to not have any carbon policy at all. And even 5 years ago, that was not the case. And so I think it's really important that corporates are on board. Investors are asking this of corporates, like what is your carbon policy? What is your net zero policy? What are your interim targets? We have a whole sort of 10-point checklist that you can go through with companies to make sure that they're on board. So I think that's something that you need to be aware of, is that it's not just governments driving it, but it's a collaboration between governments and corporates and civil society and academia, and there's just a lot of different stakeholders on board. That makes me more confident or enthusiastic that these targets can actually be met because there is a lot of momentum behind it.
One thing that Bryce and I noticed when we were looking and listening to the latest reporting season was the amount of Australian companies that were talking about carbon neutral targets, or they were already carbon neutral. It was definitely a big theme coming out of reporting season, which was great to see. When a company achieves carbon neutrality, and, you know, that can be done through buying carbon offsets. So if the company can afford to, they can do it pretty quickly. As a sustainable fund manager, what are you looking for next? Like, is there something, once a company's carbon neutral, what's sort of the next milestone that they're trying to hit or you want to see them hit? Is there anything after that?
So I think before you get to what's after that, you need to get to what's before that, because for the sustainability fund at Alphinity, we have a charter. It's a sustainability charter, and it lays out very, very clearly what kind of companies we can invest in and what kind of companies we can't. And fossil fuels is a can't.
Yeah.
So we cannot invest in fossil fuels. So a lot of and then, on the flip side of that, you have a lot of the biggest companies in global markets, Google, Apple, Microsoft, Netflix, the classic sort of FANG, asset-light companies that have very impressive and very aggressive carbon neutrality targets. And they, I think they're sort of leading the world in where you can go. So when you're running a sustainability fund that is sort of screening out or is not investing in some of those, I'll call them bad, I'm using quotation here, bad companies that need a very specific plan to change their whole energy mix and to change their emissions, we're generally not invested in those companies anyway. So when you're in asset light, already good companies, the discussion is very different. So a lot of the discussions that we have with companies are, first of all, in terms of understanding the targets and understanding those interim targets, like I've said before, because that's very critical. And then you raised a great point in terms of using offsets. So not all carbon neutrality is created equally. There needs to be discussion and a lot of analysis in terms of how you're getting to carbon neutral. And then I guess, while we're not in any sort of like bad or dirty companies, there is autos, which is a sector where you can have the discussion. So like Daimler would be an example. So they have a whole fleet or like a sort of installed base, if you will, of ICE cars, but they're moving very aggressively towards EVs. So having a discussion of how do those two things offset each other, and then what does the company look like going forward, to your initial question, what does the company look like moving forward? So I think for a lot of companies, you're not at the stage yet. Google might be one example where they're carbon neutral and sort of that's in the past and what's going forward. Most of the discussion with companies is still how are you going to get to carbon neutrality and what is the quality of that trajectory. It's very risky if they're just buying offsets and very low quality offsets because that's not fixing the underlying problem.
So Mary, when you're looking forward 2030, 2050, do you expect the momentum that we've seen over the last decade to sort of continue? And where do you and Alphinity sort of think the world's energy is going to be coming from? So
2030 is, as we mentioned before, pretty close. And I would expect that the trajectory towards more renewables in the sort of global energy pie continues the way it is going, if not accelerating quite significantly. So we were talking before about how the UN conference called COP26 is coming up in Glasgow. That's at the end of October, beginning of November. We're expecting quite significant policy pronouncements. I don't know whether these are going to actually turn into actual legislation, but certainly policy pronouncements and commitment to more decarbonization to come out of that. So there's a lot of momentum, and I think that's accelerating. I think 2050, this is my personal view, this is not an Alphinity view, but as you know, I have a PhD in economics, and as part of my PhD thesis, I spent a lot of time reading about Thomas Malthus, because I was looking at economic development. He's obviously a famous economist and demographer from the 18th century. And his theory ended up being totally wrong, right? Because he said that population grows exponentially and the words food production grows linearly, and you're going to run into a big problem and everyone's going to starve at some point. And he was wrong because of technology. He just didn't think about fertilizer. He didn't think about changing the technology of agriculture, and he totally missed the Industrial Revolution part of it, which was a big thing to miss. With all due respect to Thomas Malthus, that was a big thing to miss. But I sort of feel like on a 2050 view, which is unlike 2030, it's decently far away, that I don't know what things are going to look like in 2050. I think that there are technologies out there that we haven't even thought of. And, we can talk about Tesla later on, but Tesla is a stock that I absolutely love. And if you go back 30 years from now, nobody was thinking Tesla's going to be a massive solution to or EVs, or this is going to be a big solution to the energy transition and to decarbonization. So 2050, certainly renewables will continue to have a bigger slice of the pie, but I think there's unknown unknowns out there that are going to sort of change things from a technological perspective that we haven't thought about. And that's actually really exciting from an investment perspective, because there may be little nascent ideas right now that are not investable, but as those get bigger and as you can get more visibility on where those are going, I think those are going to be pretty exciting ideas.
So, Mary, we've got the context. You've sort of really helped us set the scene on what is going on with this transition, but we want to talk about the economic opportunity. As you just mentioned, it feels like we're at the beginning of something that is going to be pretty significant for investors. Before we get into that, though, we'll just take a very quick break to hear from our sponsors. So, Mary, let's chat about the investment opportunity. As an investor, How do you approach investing in such big change in what is now this world's energy transition?
So I think there's two ways to approach it, and then I'll tell you what the sort of Alphinity way is. So you can take a top-down approach, and you can say, okay, I know there's this very big thematic that's going to happen, and what are the sub-thematics there, and then what are the stocks that sort of fall out of that, and then invest in that stock. When China came out with the China 2060 net zero policy, I was super excited, like sleepless nights. I was so excited about this. So I tried to take the top-down approach. And so I divided the China net zero into different categories. There's going to be renewables are going to be a beneficiary, electric vehicles and electrification is going to be a beneficiary. There's going to be the EV supply chain, and then there's other, whether it's hydrogen or carbon capture and storage or sort of other ideas. And so each of the analysts on my team took one of these buckets, and we hired a special summer intern to do extra work on this. And we're going to come up with a whole raft of ideas from this top-down approach. And 6 months later, we had very, very few ideas.
Oh, wow.
And yeah, I know, it was a bit depressing.
Sleepless nights for another reason.
Yes, exactly. It just did a 180. And the reason was because at a thematic level, this can sound absolutely amazing. And then when you drill down to a company-specific level, there are issues with a number of renewable companies. So this is specifically with China, and this was in my old role. Like a lot of the solar supply chain is based in China, and it gets their production of polysilicon from Xinjiang, and that has a lot of ESG issues. So for the fund that I was working at the time, that was out. So you had a big part of one of the most attractive stories that was sort of off. In terms of wind, there are some very good wind companies out there, but there are also sometimes the economics of wind, because these are very big investments, and it's very long dated investments that they didn't stack up. And so where we sort of landed on the China analysis was that EVs and EV supply chain are a very, very attractive way to play the energy transition. The Alphinity way, Alphinity is very focused on bottom-up stock picking, and specifically looking at earnings leadership for stocks. Again, interestingly, whether you take a top-down approach or a bottom-up approach, you're kind of getting to the same answer. So if there's any advice that I could give to your listeners, it would be that make sure you do the investment case. Because if you just do the thematic case and you get really excited, you can get in some stocks that turn out to be absolute dogs. Yeah. So be excited about the thematic, because it's definitely worth being excited about. But then do the work. So at Alphinity, looking for earnings leadership, some of the stocks that we've identified, some of the wind stocks in Europe are quite interesting on a longer term basis. But right now, as you would well know, there's a lot of supply chain issues in the world. And for some of these big wind turbines, they're not, this isn't Amazon or Nike where you just charter a plane and stick the shoes on the plane and bypass all that. Like if you have supply chain issues for some of these big wind turbines, that can be quite extensive. A lot of those stocks are, like wind in particular in Europe, they're long-term winners, but they're just not investable right now. So in terms of other winners, kind of the same conclusion that I came to with China, electric vehicles and the whole electrification sub-thematic, I think is very attractive. And part of the reason is because companies like Tesla, they're just revolutionizing the whole auto industry. And so it's not sort of like a traditional energy company where they may be doing some renewables, but they still have that legacy fossil fuel business, or like Daimler, like I mentioned before, they have the bad cars and the good cars, and they are sort of canceling each other out. If you can find sort of EVs or EV supply chain companies that are just focused on this, that's a very good place to be. I guess the other thing for your listeners, which I'll highlight, is very, very simple analysis, like Porter's 5 Forces, kind of classic business school MBA sort of stuff, because the issue in some of these renewable businesses, which makes them not great investments, is that they either have very low barriers to entry. Solar might be an example there, and so the product just gets completely commoditized, and that's why you've seen the fall off in prices. Yeah, that's great if you're a consumer. That's not great if you're a company, and it's a volume times ASP sort of game. So looking at those forces, like what are the competitors, what are the barriers to entry, what are the bargaining power of suppliers, that's really important analysis to do when you're looking at renewables from an industry perspective. So to answer your question, you can look at it top down, you can look at it from bottom up. Some people do both. Alphinity is very focused on earnings leadership from the bottom up, and we have sort of a more right now, anyways, there's not a lot of earnings leadership in some of the renewables.
So you've mentioned a number of categories of investment there, shall we say, EVs, EV supply chain, wind generation, solar components. Are there any other sort of major categories that we should be aware of in the energy transition space?
Yeah, so there's renewables, EVs, EV supply chain, and then one thing which I almost hesitate to bring up because there's so few stock ideas to point to, but this is maybe one of those nascent ideas that we should keep an eye on. If you look at the agenda for COP26, one of it is actually, part of it is based on biodiversity and looking at nature-based solutions to a lot of the environmental issues in the world. So under sort of a NBS or nature-based solutions, biofuels is something that's really interesting. I know you guys, this is not under nature-based solutions, but you guys have done a podcast on hydrogen. That could have a lot of, hydrogen. I read an article recently that it's like the Swiss Army knife of decarbonization because it has so many uses. And I think that's a really good headline. It's true. So how that comes out in corporate earnings or company earnings is still yet to be seen, but that's something I'd keep an eye on. And then energy efficiency is actually a totally different sector, which this is maybe why I didn't find very many ideas in China, because I wasn't thinking about the energy efficiency aspect. But if you look at a pie chart of like energy uses and emitters by sector in the world, obviously you have electricity and heat, and then you have transportation, which is why EVs is so important. And then if you have like industry and building efficiency, that is a really clear pathway that the world needs to go on to make it to the Paris agreements. So, there's some building materials companies, like construction companies that are leaning towards more green materials. There's probably some optionality within there. And then the last thing I'll mention is green tech. So as you guys know, I love tech. It's my favorite. It's my favorite sector. So I can possibly get tech in somewhere. I'd like to do it. But a company we can talk about later is Enphase. It's a company that makes microinverters for solar panels. So it's not the actual panels. It's a high IP inverter that gets stuck on the panels and that does the energy efficiency for how the solar electricity actually goes onto the grid. So some of these more green tech, that's just one example, green tech ideas that either facilitate or enable the transition to decarbonization. I think there's going to be some really interesting ideas there.
So, Mary, there are a number of different ways to invest in this theme that you've just touched on there, and we'd love to get specific and hear about a couple of ideas that are on your watch list at the moment. Let's move to that. We asked you to come with a couple of stocks that you could tell us about, why you think they're interesting and fit in this theme, and then what the company might look like in the years ahead. I believe one of them is Tesla.
Yes. Yeah. So when you asked me for 3 stocks in renewables, and off the top of my head, the first 3, none of them were renewables. They were actually 3 stocks that are all beneficiaries of decarbonization, but none of them are renewables. So I guess that would be my first point to your listeners is take a broad view of decarbonization beneficiaries, because it's not just going to be renewables. It's going to be across many, many different sectors. So I've picked one that's a consumer discretionary, one that's a technology stock, and then one that's actually considered a renewable.
Okay. Well, why don't you give us the 3 names and then we'll go one by one.
Okay. Tesla, Enphase, and Vestas.
Okay.
Nice.
So let's start with Tesla maybe. It's such a lightning rod stock. And what I found in a lot of investor meetings is that people love it or hate it. Everybody has an opinion of it, and there's very few people that are in the middle. Yeah. So that's fine. It's all good for debate. So I guess the reasons that I like Tesla is, as we discussed before, if you look at a pie chart of emitters by sector, transportation is a very, very big slice of that pie. And so you're not going to make it to any of the interim or the longer term targets without a solution in the transportation industry. And unlike some of the other slices of the pie, there is a solution that's actually already available in transportation. And so it's not pie in the sky, a nascent idea. Like these are actually, the transition to EVs is already significantly underway. So I guess that's one thing. The second thing is, if you look at market share of EVs in the world right now, it's still under 5%. It's mid-single, like low single digit. And then if you look at what is going to be going forward, I mean, that's going to be certain companies are already saying that by 2030, 2035, 100% of their new vehicles are going to be EVs. So from Tesla's perspective, the runway for growth when you have the entire world transitioning to EVs, not to mention the opportunities for growth in countries that are going to leapfrog. So, we've talked about India extensively before, but, car penetration in India is extremely low. And what happens if EVs roll out in India and people just skip that whole ICE stage of development and you go right from nothing to an electric scooter to an electric vehicle? The runway for Tesla in terms of growth is really, really exciting. I guess the second thing which people don't appreciate about Tesla is that it's not just a car company. So Tesla is now really into solar. So that's a big part of their business that's growing very fast. And they have parts of their business that are both forward and backward integrated, which facilitate decarbonization. So they're backwardly integrating into their own batteries, and the battery supply chain is and the cost of batteries is absolutely critical to the rollout of EVs globally. And then they obviously have the supercharger stations. As you know, on the flip side, everybody wants an EV, but you need to make sure you have enough charging stations. Otherwise, it doesn't work out very well. So the fact that Tesla, it's not end to end, but it's certainly more integrated than traditional OEM auto companies. I think that's a big opportunity. One thing about Tesla, which has very little to do with decarbonization, but is an important part of the story, is their assisted driving. And the pushback on Tesla is always about valuation. Oh my goodness, it's already an $800 billion company and they hardly sell any cars, and the market cap per car is ridiculous. And I mean, the pushback.
It's more than the rest of the whole car industry combined in terms of market cap. Yeah.
Yes. So the way that you can justify or even, get upside for Tesla from here is on that technology angle, and that their technology in terms of assisted driving, from a valuation perspective, that shouldn't be valued at the same multiple as a car company. That should be valued at a multiple of a software company. And software companies, as you know, trade right now, they're trading at 30 times price to sales. So if you do a sum of the parts of Tesla, and you have the auto business, and then you have the sort of tech business, and then you have the solar business, and then you have the ancillary services like insurance, you can certainly justify this stock price, if not get more upside. So those are some of the reasons why I really like Tesla. And I guess the other thing is that, again, I hesitate to bring this up because he's so controversial, but Elon Musk is a visionary. He took a sleepy old industry that hadn't really changed since the first, Model Ford, and completely revolutionized it in a very short period of time, and did it with his own manufacturing. Yeah. So if you listen to the last quarterly call, they've just rolled out the Gigafactory in Texas, and the Gigafactory in Berlin is also starting, and he's talking about how hard it is to manufacture cars. So the fact that they've gone from idea level of electric cars to actual manufacturing to integrated business model, it's actually quite impressive.
Yeah, there's a quote that Bill Gates gave about Elon Musk back in the day that was you wouldn't mistake him for Steve Jobs. And it was seen as an insult because, Gates obviously thought so high of Jobs compared to Musk. But I reckon it's now the other way around. What Musk has done in, space and electric vehicles, all these really hard capital intensive businesses is just unbelievable.
Yeah, it is. And one of your questions was, what is the stock going to look like in 2050? So 2030, it's going to be a lot, even though it's already 800 billion market cap, it's going to be a lot bigger by 2030. But 2050, I don't know, because I was thinking, well, maybe Musk will be living on Mars, and there's going to be they're not going to have a CEO. I don't know. But 2050 for a company like Tesla that has a visionary leader, it's anybody's bet. So again, Alphinity looks at earnings leadership, and that's the other really interesting thing about Tesla right now. Auto companies around the world are in a world of pain about supply chain shortages, and Tesla somehow they just came out last weekend with their production numbers and their deliveries, and they are very good. And so Tesla, because of that backward integration, because of that tech focus, they are actually doing a lot better than other auto companies in the immediate term. So from the Alphinity process, a lot of auto companies are going to miss earnings this coming quarter by quite a lot, and Tesla looks like it's going to do well. So yeah, it's a stock that I like.
Just on the traditional automaker piece, if they're not keeping up with the transition themselves, they're likely to be gone in 10 years' time. How do you think about that from a competitive landscape? It feels like you think Tesla are going to continue to be the winner in this space. yeah, just interested in how you think about that dynamic.
Well, a lot of the European auto companies are leaning forward on this, and they realize that this is an existential risk. If you don't get on the board with EVs, you're right, you're not going to exist in a few years. And so Daimler, I mean, I said sort of before, they have the old business and the new business. They are leaning forward but quite strongly in terms of the transition towards electric vehicles. So the tricky thing from an investor perspective is not whether they're doing it, but how do you value that in one company where you have a legacy business and a new business? It's much harder. And so a lot of these OEMs, they trade at 7-8 times PE, and you have Tesla at 100 plus. And how is that? I mean, how do you reconcile that? Yeah. And I think that's what investors are really struggle with, because it's, I mean, on the surface that doesn't make sense. But to me, what that is saying is that people just want pure exposure, and they're more comfortable paying more for that pure exposure than trying to pay for some sort of hybrid, which is what you're getting in a lot of the traditional OEMs. In terms of Tesla, I mean, it's not like there's no risks investing in the stock. There are certainly a lot of risks investing in the stock, but the potential return outweighs the risks in my view. I think one of the risks is that the Chinese EV companies are taking a lot of share, and China, we talked about before, they're trying to get to net zero by 2060, and they're still developing, and EVs is a huge part of that. So whether those companies get subsidized by the government, or whether they kick Tesla out of China, or whether they shut down Gigafactory Shanghai, or I don't know, but there's risks in terms of market share that the Chinese and not unlike what you've seen in mobile phones, so that they figure out how to do a much cheaper EV sooner than Tesla does, and that they go, like if you look at Xiaomi and Oppo and Vivo, they went into emerging markets way before Apple and even Samsung. So whether there's an analogy there with EVs, and that Tesla loses out market share in some of the developed markets because Teslas are still too expensive, I think that's certainly a risk to market share also.
Yeah, I was going to ask about NEO, because that gets a lot of buzz in like the retail investor community generally. There's another competitor to Tesla that is trying to get an $80 billion valuation with zero revenue, and that's Rivian. Yeah. Any thoughts on that company?
Yes. So, okay, if you want to feel good about the Tesla valuation, you just need to look at the peers. Because on one hand, you're saying, am I paying 100 times plus PE for a stock? But you know what? It has E, so which is way better than everybody else. So I don't have. I mean, some of these valuations are just pie in the sky, and I mean, Alphinity, that is not the style of Alphinity. We are looking for companies that have earnings leadership and that are high quality and that are at a reasonable valuation that you can justify. And so a lot of those, those stocks like Rivian and even the other two. Xiaopeng in China, the unprofitable EVs, like those are just off the table from an investment perspective for me, because you don't really know what you're buying. So yeah, if you want to feel good about Tesla, relative valuation works every time.
Mary, let's move on to the second stock, which is Enphase. For those of our community who haven't heard it before, are you able to give us a bit of a brief on what they do and why you like them in this space?
Yeah, so Enphase is a US-based company, and it is part of the solar sort of ecosystem, but it's actually in the technology sector space. And as I was mentioning before, I think that the technological solutions to decarbonization are a very good place to look for good ideas. So in the solar industry, as you know, because a lot of these companies were subsidized initially, and then the price of solar went down a lot, the economics for the actual solar companies are not fantastic, because you have a commoditized product, and then you were highly subsidized, which made profitability look higher. And then when those subsidies have been removed, or if they get removed in the future, the returns on the business just don't look that attractive. But we all know that at a top line, that solar penetration is growing really, really strongly. So how do you get involved in that? And Enphase, and there's another company in America called Solar Edge, which does something slightly similar. So they have the IP, which is they're called microinverters. So say you have all these solar panels on your house, and you have two options. You can have all the electricity going into one inverter, which then tries to maximize energy that's coming from solar and feeds into the grid. But what Enphase does is they have microinverters. So they stick a little inverter on every panel, and their theory, and I agree with it, is that you get much better efficiency by having those microinverters on each panel, because then if one panel is in shade, that's fine. There's nothing coming from that panel, but you don't, sort of screw up the feed from the entire set of panels. So they have microinverters, and the reason I like it from a stock perspective is that it's a duopoly market in America. There's only SolarEdge and Enphase. So unlike solar, where you have all these players globally and you have really inexpensive Chinese players that are just undercutting the price of polysilicon and solar panels all the time, this is a duopoly market, and they do have some pricing power, and they have regulatory standards that are behind their technology. So I actually forget what it's called, but it means that you need to have one switch that can turn off all the solar from your solar panels. So in case there's a problem, you don't want them to catch fire or anything like that. And that's actually regulated in America. And so that's part of the reason why it's a duopoly. So if you take the fact that, and as a result of that, they can maintain margins. It's not that they're, constantly getting undercut. So if you take a sector that's growing at 20-30% a year, and that can have at least flat margins, if not some margin expansion, then you're getting 20-30% growth going forward. And the stock's trading at around 70 times PE, which is high, but that's not that high on a PEG basis, and it's not high given the penetration that they can have going forward. So that's one stock that I really like, that sort of plays on the technological aspect of transition to net zero.
I think that's fascinating and a really good insight into how you found a business that is in this growing space, but is like servicing the industry, and so can be like a price maker rather than a price taker. Fascinating company. We are running short on time, so we'll move to the third one, and that is Vestas?
Vestas, yeah.
I've had a problem with pronouncing companies recently. Based in Denmark, I
Yes.
believe. So for people who haven't heard about the company, can you tell us about it and why you like it?
Yeah, so as we discussed before, wind needs to be part of the solution to decarbonization, and Vestas is a manufacturer of wind turbines. So if any of you have been up close with a wind turbine, they're absolutely massive. And Vestas, historically, a lot of the wind has been onshore, and now you're starting to see a big shift towards offshore, and for a number of sort of geological or the weather-related reasons, the amount of wind offshore and the consistency of the wind offshore is a big benefit for wind powered generation. And so Vestas makes the wind turbines, and unlike solar, where there are no barriers to entry, there are actually quite significant barriers to entry in wind turbines, just because it's such a capital-intensive product, and you can't just wake up one day and decide you're going to be a wind turbine manufacturer. So in the world, it's Vestas, GE, and Siemens Gamesa, and those are kind of the three big players. And within that, Vestas is the highest quality. And at Alphinity, we're always looking for quality stocks. So it's a stock that we held in the sustainable portfolio before, and have taken it out right now because of some of the supply chain issues that I mentioned before. It's just very, very difficult for these companies to actually get to solve the supply chain issue right now. But it's certainly a stock that we like in the longer term, and we'll probably go back into the portfolio at some time in the future.
There's a lot of interest in nuclear in the Equity Mates community. So I feel like we've got to ask one question just to get your views generally on where nuclear fits into this whole transition and the energy mix, both Australia and around the world.
Yeah, so this is another very debated topic. So I had a call actually with a European bank earlier this week, me and some of my colleagues, and he was saying, we were asking them sort of about their green credentials and do you lend to nuclear? Is this good or bad? And he was saying, depending on which country in Europe we're lending to, there are totally different views. Some people are like, great, nuclear is fantastic, and other countries are like, we don't want to have anything to do with it. So this is my personal view. This is not an Alphinity view, or personally, I think that nuclear is not going to be a huge part of the energy solution. And maybe it's because I was living in Asia during the Fukushima issue in Japan, and you had people walking around with umbrellas because they didn't want the nuclear rain to fall on them. And
wow.
The risk reward of nuclear, that long tail risk that you have a nuclear disaster, from an ESG perspective and from a sort of human welfare perspective, that tail risk is quite significant. So my personal view is like, I don't look at nuclear as an option. As I said, other people in other countries feel differently, but I think that biofuels and some of those other nascent areas are probably going to be more of a solution than nuclear, just because it's so controversial.
Well, Mary, it's been an absolute pleasure having you on Equity Mates again for the second time. You've really helped us to step through what is going on with the world's energy transition, help us understand it, but also talk more importantly about the exciting investment opportunities. So thank you very much. If anyone would like more info on what you're doing or Alphinity, what would be the best place?
Yeah, so if you go to the Alphinity website, we actually have multiple sustainable funds. One is a domestic sustainable fund. So actually, Stefan, Andrea, and Bruce Smith, who are the portfolio managers for that. I know you had some questions about Australia. They're much better placed to answer specific Australia questions than me. And then myself and Jeff Thompson are two of the co-leads for the sustainable fund. You can find a lot of information on our website. Or if you just want to connect with me, feel free to contact me on LinkedIn, and happy to chat.
Well, we hope by the end of this episode that we've been able to help you understand more about what's going on with the world's energy transition a little more. As we discussed, there are plenty of benefits. And this episode was proudly sponsored by InStyle Solar, a Clean Energy Council approved retailer with over 20,000 installations to date. Not only is solar a clean energy solution, but you can consider it an investment opportunity. On average, InStyle Solar customers get a 20% return every year over 25 years from their solar system. So own, don't rent your power. With $0 deposit and zero interest finance options, you can now pay for your system instead of paying a power bill. Head to instylesolar.com/mates to get 10% off a new solar system with InStyle Solar. Mary, it's been an absolute pleasure. As always, we appreciate your time, and we look forward to catching up again.
Yeah, thanks so much. Look forward to chatting again soon.
Hey, thanks for listening to this episode of Equity Mates. We love hearing from you, so drop us a line at contact@equitymates.com, or even better, go to your podcast player and leave a 5-star review. Also, a reminder that the Equity Mates content train doesn't stop when you've run out of episodes to binge. We've got a brand new website, a Facebook discussion group. We're on Instagram, YouTube, and slowly making our way as an influencer on TikTok. Well, that's Ren. So come and say hello and join the community. We'd love to welcome you. Until next time.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. Equity Mates gives listeners access to information and educational content provided by a range of financial service professionals. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing Podcast are not financial professionals and are not aware of your personal financial circumstances. Equity Mates Media does not operate under an Australian Financial Services licence and relies on the exemption available under the Corporations Act 2001 in respect of any information or advice given. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast or video. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing Podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today.